Today our chapter is link between profit and loss statement and balance sheet. Details: the final profit figure for a business after deducting any distributions to owners is the retained profit. The profit and loss explains how this retained profit is earned. The retained profit is then added to reserves. The difference in owner's equity and hence net worth from previous balance sheet to the current balance sheet is equal to retained profit. So the profit and loss explains the change in net worth from one balance sheet to the next. This works because the profit and loss and balance sheet are prepared on the accrual basis. For the profit and loss, this means that income and expenditure is recorded in the period in which it is earned or incurred, regardless of the timing of the associated cash flows. So, for example, sales revenue is recorded as income even when the sales has been made on credit to a customer who has 2 months before they need to pay, and a purchase is recorded as an expenditure even when the purchase has been made on credit from a supplier that allows a month before payment, as well as matching income expenditure in this way to the period to which they relate. Income and expenditure are also matched to each other so that where possible expenditure is recognized in the same period in which it generates sales. You can see the balance sheet is also prepared on the accrual basis because the balance sheet contains all the missing pieces of the puzzle at any point in time. When a sale has been recorded but the customer has not yet paid up, Balance sheet contains a debtor receivable when a purchase has been recorded but the supplier has not yet been paid. The balance sheet contains a creditor payable. The amount shown as cash or the bank under current assets on the balance sheet will be determined in part by income and expenses recorded in the profit and loss. For example, if sales income exceeds spending in the period preceding publications of the account, all other things being equal, current assets will be higher than if expenses had outstripped income over the same period. If the business takes out a short-term loan, this will be shown in the balance sheet under current liabilities, but the loan itself won't appear in the profit and loss. However, the profit and loss will include interest payment on that loan in its expenditure column, and these figures will affect the net profitability figure of our bottom line. The preparation for profit and loss account precedes the working of the balance sheet, and the balance sheet cannot be prepared without the preparation of profit and loss. The profit and loss account can be prepared without the balance sheet. However, the absence of balance sheet will fail to disclose the impact of revenue term on the balance sheet, which is final position of the business. The simple accounting equation shows that the total claims are equal to the total assets of the firm. This means that the total claims include the owner's capital or equity and the liability. assets is equal to equities, that is total claim or assets, is equal to liabilities plus owner's equity. Equation number 1, owner's equity is equal to assets minus liabilities. Equation number 2, we may also define owner's equity as owner's equity is equal to contributed capital plus retained earning if there is no withdrawal from business by the owner. Then retained earning is equal to revenue plus expenses. Equation number 3, elaborating the meaning of owner's equity in equation number 1, we get assets is equal to liabilities plus contributed capital plus retained earning. Equation number 4, again we can write from equation number 3, assets is equal to liabilities plus contributed capital plus revenue minus expenses. Equation number 5, the profit is equal to revenue minus expenses.